Hello and welcome to the Bowen Basin Coke and Coal quarterly webinar. The webinar will be co-hosted today by CEO Daryl Edwards, who will be joined by CFO Andrew Mooney. Both will provide an overview of the company's March quarter performance. The overview update will be followed by a Q&A session where questions will be attended to by both Daryl and Andrew. Any questions or you do also have the opportunity to ask questions during the webinar using the Q&A panel of the Teams webinar panel. Any questions that aren't answered during the webinar or at the conclusion of the overview update will be attended to by the close of business today. A recording of the webinar will also be provided for those who need to leave early. That link to the recording will be shared via email and also published on the company's website. But without further ado, I'll now bring on Daryl and Andrew to walk through the performance for the last quarter.
Thank you, Gareth.
All right.
Hopefully you can hear me. And appreciate everyone. Thank you for your time today. Thank you for joining us. I know we all got busy schedules and lives, so thank you for taking the time out of your diaries to join us today. Pleased to have Andrew join us. First time we're presenting to the market, so really great to have Andrew on board as our new Chief Financial Officer, and Andrew comes well experienced from the coal industry. So Andrew, welcome to the team, and thanks for joining the presentation. Look, I think just at the outset, the quarterly was released earlier this week on the 28th of April, so we assume the quarterly has been taken as read. The idea today is just to step through a few items within the quarterly and to answer some Q&A, just so that we're engaging with the market a bit on the quarterly, and perhaps just to provide you a little bit more colour on the quarterly itself. Just as a reminder, the discussion today is not a presentation on the entire business and the future of the company. The idea today is to go run through the quarterly report as we've presented. So before we jump into it, I just want to remind the market just on a couple of key strategic drivers of this business and where we are and what we're trying to achieve. So there's 5 of them, and the first one is what we're trying to do here is we're trying to increase our volumes and to invest in growth. So the market obviously understands we're making investments into Plumtree and into the assets that we've got, certainly into the wash plant, which is running at steady state at the moment. So that's number 1 for us. Number 2 is to deliver a decrease in operational costs and to keep that on a sustainable basis. So we'll spend a bit of time talking about costs today. Number 3 for us is the picture that you can see behind my head and Andrew's head is the actual CHPP itself. That's what we call our cash register. So we want to utilize that as best we can. So we want to make sure that that is available and we utilize the wash plant to the best of our abilities. Number 4 for us is to improve our capital structure. And you see we've recently done a share consolidation in the market. We want to improve our balance sheet and obviously we want to improve our share price. And number 5, which is important for us, is we want to serve a growing global demand for coal, and we want to be a reliable source of supply into that market. So on the back of that, I'll just start sharing the quarterly, and hopefully everyone can see that on the screen. Gareth, can you see that?
Yes, I can see that.
Okay, so look, we'll just step through a few things within the quarterly itself. As I say, taken as read. So overall, Bowen, Coke and Coal and the management team were fairly happy with the results that we managed to achieve in the quarter. There's a few things that we could have done a little bit better, but those are largely out of our control. But the things that were in our control, we managed to do quite well. So just touching on that, the levers we're pulling from a run-of-mine perspective, we were happy with that. Probably a little bit lower than what we wanted, but weather permitting and the recovery efforts that the team achieved, we were really happy with it, with how that ended up and the results. From a product perspective, the product we produced, we were happy with that. From a sales perspective, likewise, happy with the sales results. Utilization of the wash plant was 81%. Now, previous quarters, we've been running at 91%, largely unaffected, but certainly this quarter we were affected by rain and weather, but really happy with 80%, 81% result there. So certainly it's not anything to be not happy about. So happy with that. Strip ratios we were happy with at 5.9. On the box cut, that's on track, and we're happy with the progress there. Just to remind everyone, so on the box cut and the coal coming from Plumtree North, historically, we were only expecting first coal to come in this quarter, and we managed to get quite a bit of coal out, thankfully for starting a little bit early last year before the wet season. Costs, we were happy with that, and cash flow, we had a record operating cash flow quarter. So just stepping through in a little bit more detail, we've mentioned the run of mine. We were down on the last quarter, but certainly last quarter we had a really good operating quarter in the December one. So we've spoken about the weather. I think all miners want to moan about weather. Certainly we've got a lot to moan about with the weather this quarter. So like really, really bad weather we experienced on site. So if you have a look, this was the wettest quarter since 2012. So that's 13 years. It was fairly wet. I think if you go back in history, it was probably the third wettest quarter in the last 20 years. So we experienced a lot of rain on site, 22 days of lost production within the quarter. So yeah, if you look at just February itself, if I remember correctly, we had 10 days for the first couple of weeks of February, where the guys didn't even get out of the sheds to go and get into production. So a largely disruptive quarter, but we managed to still recover, and we managed to still keep the wash plant going and produce product coal that we aimed for. So really happy with that. And we're also busy with catchback plans, and those catchback plans are running really well. So we've mentioned in the report, we've currently got 4 excavators running where we've traditionally only had 3. So we've got enough gear on site. There's a swing digger on the 4th fleet as well, and we optimizing operators and crews on site to be able to put bums on seats to be able to achieve our recovery plan. So that's running really well. Just in terms of what else we're doing, in terms of Ellensfield, we are progressing well with Ellensfield South on its own. Probably a little bit delayed from where we wanted to be, so we're still trying to get Ellensfield largely decoaled by the end of the quarter of this current quarter. There might be a risk that we spill over into the new financial year, but certainly we're doing our best to close up Ellensfield South in terms of coal flow, and then we can start backfilling the waste from Plumtree North back into Ellensfield South once that's complete. The Plumtree North box cut is on track. As I say, there might be a risk that spills over, but it depends on our recovery plans and how we go this quarter. Touch wood, since the early rains in April, we haven't had any adverse weather since then. So largely we've been focusing on water management and pumping on pits and just resetting and recovering. So we've had some really good weather the last couple of weeks in the Bowen Basin, and we seem to be into the dry season now. So look, we'll see how we go with that. Just touching on Broadmeadow East, we've completed the auger processing and operations at Broadmeadow. So overall, we didn't get all the coal we wanted out of the auger process and activity, but certainly we're still happy with the result, and it's given us some good learnings going forward for other opportunities within the Bowen complex. Just touching on the CHPP, I mean, I mentioned 81% of utilization. Typically, we'd be a little bit disappointed with that, but under the current circumstances, we managed to keep that wash plant going with ROM coal stocks that we had on site, and 81% is certainly a great result for us during the current quarter under the circumstances. What that resulted in, if we look at the mix that we had for the quarter, so our mix was 48 to 52 for the quarter, and traditionally we've been trying to focus on a 60-40. Now obviously that goes to the ROM coal that we had on site. So some of the ROM seams that we had lent itself to producing more thermal, but also we had some coking coal vessels which has slipped out, excuse me. So if you have a look at the logistics chain and the system, we've published in the quarter that there's been a 20+ delay on the port on the vessel. So we've seen some of those delays flowing through in terms of the logistics pipeline, and obviously that's affected some of the coking coal vessels. I'll hand over to Andrew now on the finance and corporate section.
Thanks, Daryl. In the March quarter, we achieved, Daryl mentioned it, record operating cash flows of $15.4 million. Important to note that that number is inclusive of $16 million in state government royalty payments that we made in the quarter, which is pleasing to see. So we've had a good operating cash flow quarter, and generating these operating cash flows has allowed us to fund the growth within the business through the box cut capital works at Plumtree North. And as we've said previously, Plumtree North underpins the next 4 to 5 years of coking coal production from the company. Year to date, our revenue is $289 million, which is comprised of 71% of coking coal sales, which is an improvement on the mix from prior year, which has helped mitigate the impact of lower index prices. So we're always trying to optimize the mix of coking coal sales compared to thermal. Costs in the March quarter in Australian dollars were $133 per tonne, and year to date $150 per tonne, excluding royalties. Our cost year to date in US dollars, to compare with some of our US denominated peers, equates to $98 per tonne, which is a very strong result and firmly places the Burton mine in the second cost quartile of coking coal mines in the Bowen Basin. Year to date, our costs per tonne are down 23% compared to the prior year, and that's a very positive message. I'm not sure a lot of coking coal producers can report such a significant reduction in costs year on year. Our CapEx has been $48 million year to date, and the majority of that spend, 90% of that spend, is related purely to the Plumtree North box cut works, which we're already producing coal from now. So with all of those metrics, again, we remain firmly on track with our guidance. Our ROM coal and sales, we're projecting to reach the high end. So ROM coal, 2.7 to 3 million tonnes. We're still projecting to produce coal at the high end of that range. Sales, 1.6 to 1.9 million tonnes at the high end. Costs, we're projecting to be at the low end of $145 to $165 per tonne. And CapEx, as I said, spend of $48 million year to date, is on track between the range of $65 to $85 million, but probably towards the low end. Daryl?
Thank you, Andrew. So we'll just fast forward a little bit. So this is something we put a little bit more disclosure into this quarterly report for the projects that we're busy running. I just want to touch on the Isaac pit. So this is our next focus area for development within the business. So Isaac pit, just if you can follow the cursor and the top side of the photograph or the map that you can see on the right-hand side of your screen. So it sits just to the north of the traditional Burton pits. There's a 3 million tonne of reserve in there, and our team is busy with the entry and pit planning and mine design approach to get into Isaac. So what we'd like to do is we'd like to have a closer look at that to be able to bring that into the product mix from the next financial year. And this is just something that we're busy working on at the moment to be able to focus on for future production and future growth. Importantly, the coking coal quality at this asset is really superior to certainly what there is across the rest of the assets. So it's a really strategic asset for us, and we'd like to get in there, and we'll see how we go with the development. So we don't want to bring that into the product mix from next financial year. And I think that's just the rest of the quarterly report. We'll take as read along. We've spoken about that within the quarter and the concept study that we're busy with, and Lenton, we've mentioned that. So I'll just take that off screen, and we'll head back to you, Gareth. Potentially there's a few questions that have come through, and we're happy to answer those.
All right, thank you for that, Daryl and Andrew. We did receive a number of questions during the week, and I'll put those to you now. Actually, I'll take captain's privilege. The first question I wanted to know, Daryl, was how were you able to keep road production rather robust with all the rain that you had?
Yeah, thanks, Gareth. Look, I think firstly, we've got to give credit to the team. So obviously the team on site has done a fantastic job, particularly with, everyone knows we've got a haul road, and that haul road's got creeks that cross it, and when you have weather, that haul road gets affected. So we've managed to do that and get product down to the TLO to put it onto trains, but also from an operating perspective, a lot of work's been done on pumping and wet weather management, and certainly in-pit management of water. And I think also we were blessed to have 2 operating pits this quarter. So we managed to step between 2 pits and get ROM coal from both pits during the quarter, which was a great sacrifice or a great privilege to have. And certainly, I think we've managed to start the quarter with good stocks and good buffers within the system. So we're spending a lot of time to focus on putting buffer material in the right place. For example, in front of the wash plant. So we managed to have all the ROM in front of the wash plant that we had. So when it was raining, we were able to process that material to produce products. So those are largely the mechanics that we've had. And we need to be grateful for the fact that we've had additional gear on site this quarter. So when we've wanted to do recovery plans, we haven't had to mobilize additional equipment and gear. That gear is on site. So it's more about equipping operators onto that gear to be able to recover.
Next question, Daryl. How is Plumtree North expected to support guidance for the rest of the year?
Yeah, so I think Plumtree, obviously we've invested in that asset early, so we could have started a little bit later, but we decided to invest in it earlier, and that started to produce coal this quarter in a meaningful way, and Plumtree will set us up. So there's 11 million tonne of reserve at Plumtree, and the efforts of Plumtree is to develop that box cut and finish it by the end of June, and Plumtree will then obviously deliver coal into the production profile from then onwards.
Okay. Next question. Coking coal continues to make up the bulk of Bowen's revenue. How are you positioning the business to take advantage of the recent rebound in premium coal pricing? And how are you managing thermal exposure in this environment?
Yeah, I think so. Thanks. That's a good question. I mean, we've said so a couple of times already. So we've mentioned the fact that we're prioritizing coking coal production within the portfolio. So obviously that CHPP that we've spoken about, and as you see in the photograph behind you. So we're prioritizing coke. We've done a full audit with Sedgman's on the circuitry within the wash plant to obviously optimize the primary product, which is a low vol HCC coking coal. We are looking at some of the product specs at the moment of ours and potentially seeing if we can adjust some of those specs to provide us with additional increased yield on the primary product. And what that does is that's obviously reduces the thermal coal component within the portfolio and the mix.
Now, you mentioned Isaac Hill along your development projects. What's the roadmap for their development?
Yeah, I think thanks for the question, Gareth. I mean, we touched on it within the quarter. I might just bring it back up on screen. So we'll just get back to the Isaac map again. So Isaac's a natural fit for us into the production mix and portfolio. So it's as I say before, it's a really good quality coking coal that's up there. Traditionally, that's the coal that the Burton mine used to mine before we owned the asset and was operated by another operator. It's really good coal. So that coking coal mix we want to bring into the portfolio, and the development of that asset is actually from where we're sitting at the moment. It's fairly easy. So if you can look at just the bottom side of that picture on the right-hand side of your screen, that's our initial pit outline and shell that we see at the moment. So we need to cross the Isaac River. On the bottom, there's a crossing that we've planned already at the moment. The haul road is already there. They used to haul coal from the top. It needs to be re-established. And we're looking at cheap, low cost capital entry to get into that pit. So we'll start it as a strip mine and progress it forward on that respect. So that's a natural fit for Isaac to come in.
And Gareth, I'll just add that we're doing some additional drilling in the Isaac Lenton areas as well to prove up additional reserves. So there's 3 million tonnes in Isaac pit there today, and Lenton next door has 19 million tonnes. So we're continuing to do additional drill works to prove up an additional reserve resource there.
Which probably brings me to my next question, Andrew. How are you thinking about funding growth while maintaining flexibility?
Well, I think operating cash flow helps, and that's what's been funding the Plumtree North box cut works that are near completion, which, as I said, secures the next few years of coking coal production for our business. In terms of balance sheet strength, that's certainly one of the key focuses of Daryl and myself is making sure that we secure the required funding to make sure that we can bring these projects online. Now, coal price always helps with that. I think we've pulled the necessary levers within our business, particularly on the cost side of the business, with costs down 23% year on year. I think the operations, we've proven a steady state of operations from Burton from which we can leverage further growth moving forward. So I think we're well positioned to exploit those reserves and, continue Bowen Coking Coal for at least 10 years with those reserves and the other satellite projects that we've got around the basin.
So talking financial standing and projected cash flows, are there any specific plans or targets under consideration for accelerating the repayment of outstanding debt beyond the currently scheduled obligations?
Absolutely. If we can, we will. But we want to make sure that we've secured ourselves in terms of the growth potential to produce the tonnages that the market expects from our business as well first. So investing in our business is the priority. We have payment plans that we're meeting with our debt providers. So we paid $7.8 million. You can see it in the Appendix 5B in the last quarter, and we're on plan with those payments. So we'll continue to pay those as required per the debt profile, but also sink the additional cash flow into the business.
Okay. That probably answers a number of questions I have here. The next question, what is the EBITDA for the quarter ending March 2025?
Well, we haven't released EBITDA because it's unaudited measure, non-GAAP measure, non-IFRS measure, but we're positive EBITDA year to date.
More of a market overview question here. What's your outlook for thermal and coking coal prices?
Yeah, I'll go. I think Andrew, both of us would probably have a different view on this, but maybe add our views. So look, I mean, obviously, coking coal was hitting 169, so we think it's probably touched the bottom and picked up a little bit. So yeah, we've seen China still exporting a large amount of steel, and until that stops, we don't really see coking coal prices escalating dramatically. So we do see China, and we have seen some news flow coming out of China saying that the Chinese are going to start curbing steel production and steel exports. We still want to see that because March they still, I think, had almost 7 million tonne of production. So let's see where that goes. But importantly, yeah, we see growth coming from India. So we are watching what's happening on the Indian market. Certainly, the Indians are planning to bring on a large amount of blast furnace capacity this year. So we are expecting the Indians to start procuring potentially before monsoon season. And we are fielding a number of inquiries in that regard. So yeah, that's coking coal from our side. And thermal coal, I think, from where we're sitting at the moment, we see it as a steady as she goes scenario. So I think where prices are on thermal coal, we'll plan according to that. But certainly, we just discussed it. And Gareth, you asked a question about what are we doing on coking coal priority. Obviously, we're prioritizing as much coking coal as possible within the business. Andrew, want to add to that?
No, that's right. That's right, Daryl. I agree with you. I mean, obviously, there's been some supply shocks in the market that's seen the price go, the PLV price go from 160 to 191 today. That certainly hasn't been demand driven. So I think it might be a bit of a steady state in the very short term. But, as we move into the second half of this calendar year, there's certainly green shoots there, particularly as, steel makers destock and India comes out of monsoon. I think it's fair to say that we can expect to see an increase.
Okay, so probably time for one last question. This one is obviously from a financial or someone good with numbers. Is there a cash flow projection that encompasses regular operations and the amortization of debt over the next 2 years, base case, worst case, etc.? And do you foresee this need to raise more capital?
Well, I mean, Andrew, I'll go first, and you might want to add on later. I think, we've provided the market with all the information necessary to perform that cash flow. So, we've given guidance on everything. So this financial year, we've provided guidance previously on the forward projections of the business we've provided to the market previously. I think if you look at some of the work we did last year in the presentations, we provided long-term forecasts and projections, certainly on tonnages and costs and all the rest of it. So, obviously, we don't know what the price is going to be going forward. So users and investors can input their own prices and assumptions into those models. Andrew, anything else on that?
No, I agree. I think, we've managed what we can manage well, and the other side's price, right? So, you know, as I said earlier, we're meeting our debt requirements. We're paying those. We're paying our suppliers on time. You know, our business has performed well in the last quarter, and you know, with based on projections of price, our business is positioned very well to take advantage of a price uptick.
Yeah, so I think I just want to finish on there. I mean, we're obviously trying to control what we can control. So the levers and the methods at our disposal, we are controlling that to the best of our ability. Commodity price is outside of our control, but we'll focus on whatever we can control.
Okay, that's a positive note to end on. Thank you for your time this morning, gentlemen. That brings the webinar to a close. Any questions that weren't answered or that will come in, please feel free to send them through. They'll get answered before the close of business today. All right, so that's the end. I will now end the event. Thank you.
Thanks everyone.
Gary.